Patrick.
Yeah.
How does the legacy builder work?
The legacy builder is a financial product that works for nonprofits. So it leverages wealth. So if you're talking about history and how it all works out, is that credit, for example, is leveraging wealth. You go to a bank, they have $1 million, and you say, I want to borrow $5,000. They go, okay, you're going to give us $8,000 back on the $5,000 over 5 years. And you go, okay, so you're using their wealth to get some money, right? So you're leveraging something.
Okay.
So how the legacy builder works, it is leveraging. It's for nonprofits, and it leverages a donor's wealth.
Yeah.
So if the donor was going to give $1 million to the nonprofit, then what the nonprofit does is takes that $1 million and then gives it to a financial company, right? And then you leverage that wealth with their wealth. So you leverage the $1 million with their $490 million, right? So they take the $1 million and they put it in their $490 million kitty, right?
Yeah.
And then what they do is say, listen, I'm not going to give you this $1 million right back. I'm going to hold it for a while. And the way the contract works is I'm going to hold it until the death of the donor, right? Because it's for nonprofits. So they'll say, I'll hold it for 17 years, 20 years, for the lifespan of the donor. But what I'll do is, because I'm taking your $1 million, I'm going to give you $20,000 a year, $25,000 a year income off of this until this person dies, right? So every year income stream comes, which is basically interest, right?
Uh-huh.
And then 22 years later, when that donor passes away, the principal was building the whole time because they're an investment firm. So they invested that $1 million with their $490 million. And then you get a return of like $2.2 million. But you received an income stream of $25,000 for life, for example. Does that make sense? So we used to do this back in the day. It was called premium financing. And so we took it to like another level, and the banks got in the middle of it and said, ho, don't write $1 million check and be out $1 million. We'll leverage your wealth.
Yeah.
Right? Mm-hmm. And we'll write a $20 million policy on you, right? And instead of giving us $1 million, give us $18,000 a year, and we'll leverage your assets, right? We'll hold money on the side here.
Okay. So
the donor comes out with $18,000 a year. The bank is, in a sense, premium financing the actual amount of money he was supposed to pay, almost like $1 million per year. But they were putting that to a side. They wrote a huge policy, like a $20 million policy. The guy dies 20 years later. The bank says, wait a minute, you owe me $5 million, right? Okay, here's your $5 million to the bank. Because the bank, lent him premium finance the payments. And then the nonprofit gets $4 million. Mm-hmm. The lender didn't pay anything, hardly, the donor didn't pay anything, hardly.
Yeah.
And then the nonprofit gets all this big money, and the rest goes to the kids. Mm-hmm. So that was called premium financing. And I used to do that, 20 years ago, but 2008, the market dropped out on that. So now we keep it simple and do the legacy builder, which is here, we don't keep leveraging and leveraging and leveraging wealth. It's kind of like, all right, a simple way to do this is give a board of director gives $1 million every year, which is, after a while, it's kind of a stupid way to give, because it's like, well, put that $1 million in this policy, receive income stream for life, and then when you pass away, it's $3 million, $9 million, depending on the age of that board member. Mm-hmm. So it doesn't work in every case, but 20% of a nonprofit's money should be invested in these types of vehicles. Okay. Because of the way the baby boomers are going and all that nonsense. They're going to run out of money. In 15 to 21 years, nonprofits are going to be losing the big dogs, and 14 to 17% of their big money. So the funny part is 12% of income. So you have a year's worth of money coming into a nonprofit, right?
Okay.
Only 12%, the bulk of that money, 88% of that money is coming from like 12% of the people. So you've got these major donors that are like carrying the nonprofit.
Mm-hmm.
And then the rest are these $50, $80, $400, $900, $2,100 donations. But it's 12% of the donors are carrying nonprofits. All of those are going to leave because all of those are baby boomers. So when they die, if nonprofits don't have their money in these types of vehicles, where they get like a huge paycheck at the end of this, if they don't have at least 15 to 21% of their money in this kind of ratio, then they're going to be begging much harder in the long term. I mean, it's going to be bad. It's actually a quiet tsunami that's coming. It's similar to like climate, the weather. The weather.
Climate change.
Yeah, climate change. Like whether you like it or not, one day the tides are rising, whether you believe it or not or care about it or not. But this is eventually going to the chickens will come home to roost for nonprofits. So there's a little firm that does this, that we send our business to in Iowa.
Okay.
They've been doing it for a long time. I'll link to them if you're recording this, like you say you are. I'll link to them, and you can send the video out and let people play with it or whatever they want to do. But legacy builder programs are smart for nonprofits. It's a nonprofit investment vehicle only. Other people can't do it. And the reason the tax code is because it's for the greater good.
Okay.
So that's why it can happen. That's why premium financing was allowed. Nobody was really coming out of pocket with money. It was all borrowed funds, leaned. But when the markets crashed and banks crashed, everybody crashed, that industry kind of crashed with it. And I never got a taste for it after that. I just was like, let it go. But it's cool program. Any other questions?
So you say this tool is mostly for like nonprofits? Is that who our target market is?
Yeah, it's a tax code. So when the insurance product is made, it has like a code, and the tax code that it was made under and approved under was like a nonprofit code. So nonprofits are like a 501c3, for example. And when they make insurance products or investment products, they have codes. And that code is either for residential or business or commercial or nonprofit, right? So this is a nonprofit product. And there are other products that human beings can do, but if the money goes if the beneficiary on the investment product is a nonprofit, then they get the tax write-off.
Okay.
So that money is actually, that $25,000 a year, for example, is legitimately a tax write-off.
Okay.
It's insane. Because it is what it is. It's a charitable product. So the money's going into it or a write-off, money's coming out of it or a write-off. Because it went to a charity. You could split it. If you write a $5 million policy, let's say you gave somebody $5 million. You can give $1 million to the charitable fund, and then, the rest of the money can go to your kids, for example. But there has to be a charity involved.
Okay.
Anything else? All right.
I think I'm good.
Cool beans. Good questions. I like these questions. Keep them coming. Because I'm here to help. I'm here to help.